What do you do with a big multinational industrial company in this environment where everyone's suddenly fretting about a possible trade war? Take United Technologies, the maker of elevators, aerospace components, climate control equipment, and security systems. While the global economy is on fire and management has floated the idea of breaking up the company to unlock value, the company's going to be hit directly by the president's new steel tariffs, and it's an obvious target for retaliation if our trading partners decide to go tit for tat. That's why the stock is down nearly 8% from its highs, despite blowing out the numbers. But if you think these worries are overblown, we could be looking at a nice buying opportunity. So which is it? Earlier today, I got a chance to check in with Greg Hayes, the forthcoming chairman and CEO of United Technologies. Take a look. Greg, it's good to see you, and I understand the Analyst Day went very well. Just give me a 30,000-foot overview of the main points that you made.
Hey, Jim, it's good to see you as well. So today we hosted our annual investor meeting. We had about 75 of our key institutional investors as well as some sell-side folks. And we actually highlighted each of the four businesses, Pratt, our aerospace systems, our climate business, and the Otis business, and just really reiterated what the goals are for the next 3 years financially, as well as the investments that we're making in innovation.
Now, did you stress some of the longer-term views, urbanization, middle class, long-term demand for aerospace?
Yeah, it's actually the part that I covered in my intro this morning. If you think about the big macro forces driving the world economy, that is urbanization, that's the growth of the middle class, that's the growth in revenue passenger miles for air traffic. All of those trends are the things that are going to benefit our business over the next 5, 10, or 15 years. And if you think about aerospace specifically, it's about 29,000 aircraft flying today in the world, commercial aircraft. By 2030, so 12 years from now, that number will be 47,000. And in those next 12 years, you'll have to produce about 30,000 new aircraft in order to meet the demand. That's a huge number of aircraft. So it's more that we're going to build more in the next 12 years than we've built in the last 50 years. So a huge ramp. But again, it's really why we're in the commercial aerospace business, is to take advantage of that big macro trend.
Now, one of the things I was thinking of you in the last week because of this Larry Kudlow, my old friend from Kudlow and Cramer, and versus the hardliners who won tariffs. And I think that so much of what you do, you're a dominant player in China for our country, whether it be Otis, where you really have just made your name. Aircraft, we know that the Chinese need so many. At what point are you concerned more about politics than you are demand, which is incredibly strong?
Yeah, so I think that is a concern, an overriding concern that we have today, is we don't want to see a trade war with China. Again, we import a lot from China. They import a lot of aerospace parts from us, and specifically from Boeing. As you know, Boeing is the biggest customer that we have on the aerospace system side. A trade war, nobody wins. And I think, the fear is if we get into this tit for tat on tariffs, that's going to be a problem. So hopefully the Chinese will react as they have so far, which is with some pause, and we're not going to go down a bad path here, but it is a concern.
Now, I know that you did discuss the worries about commodity costs because you're a gigantic buyer of the metals that the president is putting tariffs on. But at the same time, this is probably the best I've ever seen. All three, well, I guess we can call them four because of the way you divide aerospace, the best demand I've ever seen. So how do you balance those?
Well, if you think about, the metals, right? So we buy 500,000 or 600,000 tons of steel a year. We buy 3 million pounds of aluminum. But most of that is actually bought outside of the U.S. Only a third of the metals are actually made or bought here in the U.S. And so as we think about the impact to the business in the short term, it's not going to be significant. It may cost us a couple, 3 pennies this year. And some of that you'll recover through pricing. But it's one of those worries out there. Again, if you start with tariffs on steel and aluminum, where do you go next?
Right. I think that we all have to recognize that lots of companies are getting shaved 2 or 3 points. You've got something going that I think people don't understand, Greg. People feel that all engines are the same. Oh, one aircraft engine is the same as another aircraft engine. That is not the case, right? Because of engineering, you have changed the game.
Well, yeah, I think it's beyond just engineering. It's innovation, Jim. If you think about what Pratt has done with this geared turbofan that we talk so much about, it's a $10 billion investment that we made in engineering and development over the last 12 years. And fundamentally, it changes the game in commercial aerospace. And you and I have talked about this. I mean, the engine is about 16% more fuel efficient than the engine it replaces. It's got about 75% lower noise signature, and it's got about a 50% reduction in emissions. So if you think about it, I mean, each one of the engines that typically gets introduced, you'll have a 2 or 3 point increase in efficiency. This is 16 points. And frankly, despite some of the teething issues that have been out there, the customers love the engine.
All right. Now, you did see these, talk to a lot of your investors. How many of them feel that climate controls, aerospace, they don't necessarily go with elevators? How many people said, you know what, this is the time, Greg? I know some of the shareholders are really agitating for this. And how many just feel like this is a great synergy?
Well, I think it's interesting because we asked that question, and I heard from a lot of investors today. Some of them say, absolutely, you need to break the company up because elevators and air conditioning have nothing to do with jet engines. Some of the other investors who have been around have perhaps a longer-term perspective, understand the benefits and the synergies that you have from having a large company together. Best-in-class SG&A at around 10%. None of the industrial peers have that. And we have it because of the scale of the business. And so obviously you lose some of that if you break it up. But it's still something we need to think through. We need to go through the process. And I think we owe investors an answer by the end of the year.
Well, Greg, I'm glad you mentioned, because I know that a lot of the CEOs, including you, say, look, we got to have the board think about it. I was looking at your board. You're uniquely set up to make a decision about whether this is right. I've known Fred Reynolds for years. He's on the boards of Mondelez and Hess. Those are two companies that have faced exactly these issues. Ellen Coleman, few people have understood the need or not need to split things up. And then, I've known Brian Rogers since the 80s. I think he's one of the greatest investment minds of all time. If I want to know whether I should break up, I think he would be probably the first person I would call. Would the valuation go up? So is your board, are those people going to be sitting down with you and saying, you know what, we think that this would be best for stakeholders, this best for shareholders? Because this board is uniquely, really, if you task them with it, they'll come up with the right answer.
No, look, Jim, we are blessed to have a great board of directors. I think you mentioned just a few people. But you've got J.P. Garnier, who's had a career at Glaxo. You have Terry McGraw from McGraw-Hill Publishing. You've got just a great group of people that have a keen understanding of the investors and of the business. I would tell you, though, the first thing the board, and I've told them, we had our board meeting here just 2 days ago, I said the first thing we need to do is close on Rockwell Collins. And so we'll do that in the next 2-3 months here. And then once we've closed on Rockwell, once we've started the integration, I told the board we'd go through a process by the end of the year to make a decision. And I would tell you, having a Brian Rogers on the board who's been at T. Rowe forever, having Ellen, who went through this process while she was at DuPont, having Fred Reynolds, who's been through this process a number of times as a board member, those are invaluable insights. And so it's not like we need to go outside and ask a lot of questions, because I think the board truly understands what's important to investors and the long-term stakeholders in the business.
All right. Well, look, congratulations on just a great run since you've come in, done so much right. I personally just think that they're both good options, staying with and break it up, but I'm sure you'll make the right decision. Greg Hayes, Chairman and CEO of United Technologies. Thank you so much, sir. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.